A loaf of bread. Same wheat, same flour, same oven, same baker. 2 years ago, it cost you $2.49. Today, it costs $4.19. Nothing changed, and yet somehow, everything did. This isn't a story about greed. It's not really a story about supply chains or wars or bad harvests. It's a story about something far more invisible and far more permanent. Once you understand it, you'll never look at a price tag the same way again. Let's start with a confession. Most people, including a lot of people who study economics for a living, explain inflation wrong. They say prices go up because things cost more to make. Oil gets expensive, shipping gets expensive, workers want higher wages, so companies raise prices. Simple. And that's part of the story, but it's the easy part, the comfortable part, the part that lets everyone point at someone else. The harder part, the part nobody really wants to talk about, is this. Prices can go up even when nothing costs more to produce at all. Permanently, structurally, by design. In 2021, the United States saw inflation hit 7%. The UK hit 11%. Argentina was already at 50% and climbing. Across the world, people were watching their grocery bills rise, their rent rise, their utility bills rise, and they were told it was temporary, a blip, a transitory phenomenon, in the now infamous words of the Federal Reserve. It was not temporary. And the reason it wasn't temporary is the same reason prices always tend over time to move in one direction. Upward. Always upward. So today, we're going to get into the actual mechanism, not the politics, not the blame game, the mechanical, almost mathematical reason that a dollar you have today will buy less next year, and the year after that, and the year after that. Ready? Good. To understand why prices rise even when nothing costs more, you need to understand one concept first. One concept that runs underneath all of modern economics like a foundation nobody talks about. Money is not a thing. It's a promise. When you hold a $20 bill, you're not holding something with intrinsic value. You're holding a note that says the government promises you can use this to buy goods and services. That's all it is. A collective agreement. A social contract backed by trust and by the threat of taxation, which is how governments make sure you keep using their currency. But we'll come back to that. Now here's where it gets interesting. If money is just a promise, then the value of that promise depends on how many promises are in circulation. Think of it this way. Imagine a tiny island economy. 12 people live there. There are exactly 100 coconuts, and there are exactly $100 in circulation. One coconut costs $1. Clean, simple, balanced. Now imagine the island's government prints another $100 and hands them out. Suddenly, there are $200 chasing the same 100 coconuts. Nothing about the coconuts changed. The trees are the same, the harvest is the same, but now each coconut costs $2. This is the oldest and most basic version of inflation. More money, same stuff. The money dilutes, like pouring water into orange juice. This is called monetary inflation, and it was first described clearly by an economist named David Hume back in 1752. Yes, 1752. We've known about this for nearly 3 centuries, and we still do it, over and over. Because the alternative, not printing money, has its own set of problems. But here's where the modern story starts to get strange. Because in today's world, governments don't just print paper money anymore. Not mostly. What they do is something more subtle, more invisible, and arguably more powerful. They create credit. Banks don't just hold your deposits and lend them out to other people. That's the story we're told in school. Here's what actually happens. When a bank approves a mortgage, a car loan, a business line of credit, it doesn't go to a vault and pull out existing money. It creates new money right there by typing numbers into an account. The money didn't exist before the loan was made. It exists now because the loan was made. In most modern economies, roughly 90 to 97% of all money in circulation was created this way. Not printed, not minted, typed. Let that sit for a second. The money in your bank account right now is, in a very real sense, someone else's debt. It exists because somewhere up the chain, someone borrowed it into existence. And what does debt require? Interest. And what does interest do? It means that more money must be created tomorrow to pay back today's loans, which creates more money, which dilutes the value of the money already out there, which makes prices rise. It is, structurally, a system that requires inflation to function. Now let's go one level deeper, because if you just walk away knowing banks create money, you've learned something true but incomplete. The part most people never reach is the role of expectations. Here's the uncomfortable math. Inflation doesn't just happen because of what money is doing right now. It happens because of what people think money will do in the future. If you believe prices will be higher next year, you ask for a raise today. Your employer, knowing wages are going up, raises their prices to compensate. Their suppliers, seeing their customer willing to pay more, raise their prices too. And now prices are higher, not because any input cost changed, but because everyone acted as if they would. This is called the inflationary expectations spiral, and it is extraordinarily hard to stop once it starts, because the belief itself causes the thing the belief predicts. The Federal Reserve, and most central banks around the world, are obsessed with managing this. Their entire mandate around interest rates is, at its core, about controlling what people expect prices to do. When they raise rates aggressively, the message they're sending is not just borrowing is now more expensive. It's we are willing to cause a recession to prove to you that we will not allow runaway inflation, so please update your expectations. They are, essentially, playing a psychological game at a civilizational scale. In 1980, Paul Volcker, then chairman of the Fed, raised interest rates to 20%. 20%. The U.S. economy was thrown into a severe recession. Unemployment hit 10.8%. Businesses collapsed. Mortgage rates shot past 18%, which effectively froze the housing market. People were furious. There were protests. Farmers drove their tractors to Washington, D.C. and blockaded the Fed building. Volcker held the line, and it worked. Inflation, which had been running above 14%, collapsed to under 3% within 3 years, not because the cost of making anything changed dramatically, but because the expectation of inflation was broken, violently, painfully broken. The lesson the Fed took from Volcker was stark. Credibility is the only real tool a central bank has, and credibility is expensive to rebuild once lost. Now here's where the irony enters. The very tools central banks use to fight inflation also create the conditions for future inflation. Low interest rates encourage borrowing. Borrowing creates money. Money chases goods. Prices rise. The Fed raises rates to slow it down, which slows the economy, which causes the next crisis, which causes the next round of stimulus, which causes the next round of inflation. They are, if you'll permit the metaphor, attempting to put out a fire using gasoline, but in very precise, carefully calibrated amounts, and with a great deal of confidence that they know exactly how much is too much. Sometimes they do. Often they don't. So we've established the mechanism. Money expands, expectations amplify, central banks react. The cycle continues. But there's a layer of this story that financial media almost never touches because it makes everyone involved look bad. And that's the gap between who causes inflation and who pays for it. The hype version of the inflation story sounds like this. Supply chains broke down during the pandemic. Gas got expensive because of the war in Ukraine. Wages rose because of labor shortages. It was all very unfortunate, and now it's being corrected. The reality version sounds like this. Between March 2020 and June 2021, the U.S. Federal Reserve expanded its balance sheet from $4.2 trillion to over $8 trillion. The money supply, M2, grew by 26% in a single year, the fastest expansion since World War II. To put that in terms of the coconut island, they doubled the number of dollars, and then they were surprised the price of coconuts went up. But here's the quiet injustice buried in all of this, and it's the part that should make you actually uncomfortable. Inflation is not a neutral tax, it is a regressive one. When you hold cash, when you have $10,000 in a savings account earning 0.5% while inflation runs at 7%, you were losing $650 a year in purchasing power without anyone taking it from you. It just evaporates, silently, invisibly. Now ask yourself, who holds cash? Mostly people who can't afford not to, working families with small savings, retirees on fixed incomes, people in developing countries who don't have easy access to stock markets or real estate or inflation-hedged assets. And ask yourself, who benefits from inflation? People who own things. Asset prices, homes, stocks, commodities tend to rise with inflation or ahead of it. If you own a house worth $400,000 and inflation runs at 7%, your house is probably now worth $428,000. Your mortgage didn't change. Your gain is real. Your neighbor who rents, their rent just went up. This is not a radical or partisan observation. It's arithmetic. Inflation transfers wealth from those who hold money to those who hold assets. And because asset ownership is not evenly distributed, the top 10% of Americans own roughly 89% of all stocks. The effects are deeply unequal. The official line is that a little inflation is good. It encourages spending over hoarding. It keeps the economy moving. A target of 2% is considered healthy, optimal, the Goldilocks zone of monetary policy. That may be true in aggregate, but averages, as always, hide who's doing badly so that the average looks fine.
Every major currency in history that was managed by a government has, over long enough time periods, lost value. Every single one. The British pound, which once dominated global trade, has lost roughly 99.5% of its purchasing power since 1750. The US dollar has lost about 97% of its value since the Federal Reserve was created in 1913. This is not a bug, it's a feature. Governments benefit from mild inflation because it erodes the real value of their debts. If you owe $30 trillion and inflation runs at 4% for 10 years, the real burden of that debt quietly shrinks while nominal GDP rises. The debt looks smaller in relative terms without anyone explicitly repaying it. It is, functionally, a slow default, polite, legal, and never called what it is. The implications stretch into territory most economic conversations avoid, because if inflation is structural, if it's baked into the architecture of how money is created and how governments finance themselves, then the advice to just save more becomes darkly ironic. Saving in an inflationary world is a losing strategy. You must invest or lose ground. And investing carries risk, and risk isn't evenly distributed. And so the very design of the system pushes everyone toward a casino they didn't ask to enter.
Which is why, in recent years, you've seen the rise of alternatives: gold, inflation-protected bonds, and more controversially, Bitcoin, whose advocates argue its value comes precisely from the fact that no one can print more of it. The supply is capped. The argument is elegant. Whether it works as a solution to what we've described today is, frankly, still open. But the argument is worth taking seriously, not because Bitcoin is necessarily the answer, but because the question it's asking is correct. If the problem is that money loses value because more of it can always be created, then is the solution a kind of money that can't be? That is not a rhetorical question. Smart people disagree strongly, and that disagreement is live. So, back to the bread. Same wheat, same flour, same baker. Still $4.19. Here's what changed. The number of dollars in the world went up. The expectation that prices would rise became self-fulfilling. The assets that protect against inflation, homes, stocks, real estate, went up faster than wages for most people. And no one was ever held accountable, because no one did anything technically wrong. The farmer didn't raise prices out of spite. The baker didn't get greedy. The bank was following its mandate. The Fed was following its models. The government was managing its debt load. Everyone was rational. Everyone was incentivized correctly. And the system, through the accumulation of all those rational individual choices, quietly picked your pocket. That is the uncomfortable truth at the center of this story. Not that someone is evil, not that the system is broken, but that it is working exactly as designed. The question worth sitting with isn't who's to blame. It's this. If a system can take value from everyone who holds money, slowly, invisibly, legally, and without anyone being responsible, does it matter whether we call it a tax,